Good afternoon, everybody. Today is Wednesday, February 6th. I'm Andrew Packer, editor at Newsmax, welcoming all of you to our monthly financial brain trust call. For the first time ever, I'd like to welcome our subscribers on the live call. If you would like to ask a question for our special guest or any of our brain trust members today, you can hit *3 to be connected to a call screener. Please remember that these calls are being recorded, so if you're not speaking, please put your phone on mute to minimize background noise. As always, please speak clearly and state your name when you first start speaking. This month, it's my pleasure to introduce John Williams of ShadowStats. John holds a BA in economics, an MBA, and has served as a consulting economist for individuals and Fortune 500 companies. As a result of developing more realistic economic models for a client, John came across some faulty numbers being reported in gross national product by the Department of Commerce. From there, this grew into ShadowStats, which launched in 2006 and adjusts government data to more accurately reflect the changes in economic reporting by government agencies. So at this time, I'll turn things over to John Williams to talk more about the process of adjusting these government-reported numbers and the trends he's noticing today that are of particular interest to investors. John?
Thank you, Andrew. I've been a consulting economist for 30-plus years at this point, and I found early on that what was happening with the economic statistics was increasingly moving away from common experience. I also found that I had to have a pretty good idea as to what was actually being reported in the different data if I had any hopes of being able to make meaningful forecasts for my clients. What I found over time, and it has been an increasing problem, is that the key numbers that are widely followed have been changed in terms of the methodology that's been used in terms of putting together, let's say, the headline CPI, the headline GDP, or the headline unemployment rate. And what I did, or what I have done, is to try and look at those changes, assess them, and where I think they're counter to what most people view as reality in those areas, to adjust for them and try to restate today's numbers for what they would be using the older methodologies, which I think generally are closer, again, to common experience. Very specifically, let me look at the CPI for a moment. This is, as most people would view the Consumer Price Index, for investment needs or for needs of adjusting salary, income. Most people think of the CPI from the standpoint of measuring the cost of living, of maintaining a constant standard of living. And it also goes without saying, I think, that most people expect that what they're seeing measured reflects out-of-pocket expenditures. That no longer is the case with the CPI due to methodological changes. Going back a couple of hundred years, all the popularly followed CPI indices have been based on measuring the costs of a fixed basket of goods. Very crudely put, let's say you have a pound of steak, a gallon of gas, a loaf of bread. The government would measure the cost of that one year, that would measure that same package the next year. Whatever the cost of the package had changed by, that's how much your income would have had to go up or down in order to have maintained a constant standard of living. In the 1990s, Fed Chairman Greenspan and then head of the Council of Economic Advisors, Michael Boskin, began making a lot of noise as to how the CPI overstated inflation, and that if only they could get a more accurate CPI, which would be a lower CPI, that would reduce things such as the cost of living adjustments on Social Security. That would help to bring down the deficit, and no one in Congress would have to do the politically impossible thing of voting against Social Security. If you ask them why the CPI was overstating inflation, the answer simply was, and then the example that Greenspan used was if a steak gets too expensive, people will buy more hamburger, a cheaper substitution. Well, while that may be true, and in that case their cost of living would be less, that's not a cost of living that maintains or measures maintaining a constant standard of living. Violated the whole concept of the CPI. There's an effort there to shift the CPI from being a measure of a fixed basket of goods to a substitution basket. What they've done to the CPI since is gerrymandered all sorts of things that would make it approximate a substitution-based index, but it's not fully such. They've created the chain-weighted CPI, which is sitting in the background to take over when it is politically accepted, that will be fully substitution-based. But the substitution-based indices do show lower inflation. That's just by definition. Using lower inflation, well, there's one other element with the inflation. That's where they have hedonic quality adjustments that are they're nebulous adjustments to the cost of products where the government's deemed there's been a quality improvement, but they can't measure the quality change so that they can appropriately adjust inflation. They model it econometrically, unlike things where they might find a smaller candy bar versus a larger candy bar in the same wrapper. That can be mathematically altered, but the changing textbook valuations because they have colored pictures in them or not, that's the type of thing that the average person just doesn't sense as being what they're getting with their product. If the product is in the CPI devalued because the quality's higher, the average person doesn't see that. They don't realize that what's being measured is not what they're paying out of pocket. So the effect here is with inflation, number one, if anyone's looking to target their investment return, using the government's number, they're not going to stay ahead of inflation. Depending upon whether you look at inflation as it was calculated in 1980 or as it was calculated in 1990, you can add 3 to 5 percentage points to what's being reported today, which would put you up in the 5 to say 7% range in terms of actual inflation. The inflation number affects the economy. If you look at the GDP, I'll contend that the economy never recovered from this downturn. Reason being is that the inflation that's used in deflating the GDP number is adjusted for inflation, is too low. It's different than the CPI. You have approximately 2 percentage points in these hedonic quality adjustments that should be backed out to have everything on a consistent basis. If you do that, you'll find that instead of having a GDP that plunged and bottomed out in June of 2009 and has since had a full recovery, it's now above where it was before the downturn. It didn't recover. It just stagnated, and now it's turning down again. Perhaps supporting that somewhat is that there's no other major series that shows the same pattern of full recovery. What we're coming into with the economy will formally be recognized as a double-dip recession, where in reality it is really a continuation of what started back in 2006 to 2007. On the unemployment front, the government does not count all the people who used to be counted as discouraged workers. These are people who consider themselves to be unemployed, but they haven't actively sought work in the last 4 weeks because there are no jobs to be had where they live. And where the government publishes 6 levels of unemployment, the headline number, which is their U3, was reported on Friday at 7.9%. That's the third level. The 6th level, which is their broadest measure, includes a measure for discouraged workers. I call them short-term discouraged workers because they've only been discouraged for less than a year. It also includes people working part-time for economic reasons where they can't get a full-time job, so they're forced to work part-time. That's up at 14.4%. And if you count in the people who've been shoved into the long-term discouraged worker category, this is more than discouraged for more than a year. They used to be measured 1994 and before. Canada still measures them. You'll find the unemployment rate would be up around 23%. And I'll contend, in terms of common experience, if you went around the country and surveyed everyone as to whether or not he or she was unemployed, you'd end up with a number pretty close to that. In general terms, what I'm looking at here is at an economy that has not recovered. There are good reasons for that in terms of structural problems with consumer liquidity. The consumer does not have the ability to fuel a sustainable economic growth, positive inflation-adjusted economic growth here. You have not had a recovery. One is not pending. The inflation rate is running higher than has been estimated by the government. And because of the deficit problem, and I'm talking now using generally accepted accounting principles, where the deficit that was reported for 2012 at $1.1 trillion, a cash-based number, the headline number. We just got government financial statements where you can look at it on a GAAP basis, and adding in the year-to-year change in the unfunded liabilities net present value, you'll see a deficit of around $6.6 trillion. That is beyond containable. It's an absolute disaster that eventually will either spell some form of insolvency for the U.S. government, or the more likely case where the government will print the money that it can't otherwise raise. You can't bring this into balance by raising taxes. You can't raise taxes enough, and there's no political will in Washington to make the cuts, particularly the reorganization of the social programs that's needed to bring this into balance. So that as the global markets adjust to this and we get through the politics of the next month or two, I think you're going to see heavy selling against the dollar. That in turn will intensify the inflation problem. We're going to have a tremendous inflation problem going forward here. So looking at it, things from an investment standpoint, I would look at things that will do well in an economy that, number one, is not recovering, probably is turning down again, be a down leg, double-dip recession, much higher inflation, and a much weaker U.S. dollar. So I give you that as background, and I'm happy to address all those issues or any part of them in questions or otherwise.
All right, thanks, John. Appreciate that opening commentary there. So if I was looking, kind of at these adjusted numbers the way you are, as an investor, what would my best course of action be, sort of on a broad, kind of, overview? Should I be investing in other countries, working under the premise that these governments might be doing the same thing? Should I be investing in hard assets like real estate, commodities, gold, silver, that sort of thing, or what?
The United States has done this, has put itself into a position of long-term insolvency much better than any other major country that I'm aware of. I'll contend that the U.S. is the elephant in the bathtub of sovereign solvency here. You want to be out of the dollar. I see the dollar becoming worthless in the years ahead. I'm formally predicting a hyperinflation by the end of next year. And if you go to my website, top right-hand column, I have a paper there that gives you the rationale behind that. And I'm, again, happy to get into details with it. We are limited a little bit in terms of time here. But in that type of an environment, I would move assets outside the United States, outside the U.S. dollar. I like, in particular, the Swiss franc, despite its temporary tie to the euro, the Canadian dollar, and the Australian dollar. But basically, this is a circumstance where I'd look to batten down the hatches and basically look to preserve wealth and assets, or the wealth and assets of my my clients. And a primary hedge there would be physical gold, also silver, indeed the hard assets. You need to be able to ride through a very difficult time in terms of having the hard asset, liquid hard assets. Items such as real estate are not portable. You may have short-term liquidity problems, but over time, they're a wonderful store of wealth. And I would have that real estate as well. But just keep in mind that it's more of a long-term holding than the gold or silver, which I'd use as a primary short-term hedge, with which you will hopefully still have liquidity as things get very difficult.
All right. Well, thanks, John, for sharing your views. I know a lot of our Brain Trust members would like to ask you some questions, as well as some of our subscribers.
Okay.
Our subscribers can call in and talk to a screener by hitting *3 on their phones. But I'd like to start with one of our Brain Trust members, specifically John Brown. John, are you still with us?
John, yes, I am. Sorry. I am, yes. Andrew, I'm at the airport. That's why I'm on the way to Nassau, so I was just wanting to get in first, if I may. John, I'm a great reader and admirer of your work, and I have two burning questions. One is that I've been writing that hyperinflation will take some time to show. And one of the reasons, and I'd like to know if you think I'm right, in thinking that the main reason that we haven't seen hyperinflation yet, despite these massive quantitative easings, is that as long as the bulk of the funds remain as bank deposits, they form part of the monetary base. And it's not until the banks lend them, and often leverage them out, that they come into the money supply and therefore lead to an explosion in inflation. Am I correct or incorrect?
Yes, you are correct on that. There are some things I would add to that, but and I can't argue with the thing you've said there. So if you want to get your second... Well, in other words, if you want to give your second question it may relate to it, in which case I can address them both. But yes, I agree with what you said.
On the second question, on your website, you had a very interesting statement that I thought I understood, but I'd just like you to explain it further. Reported contraction in real GDP was designed to discourage fiscal reform. I think I understand what you're saying, but if you could expand on it, I'd be most grateful.
Okay, well, that's the simplest one. Let me start with that, and then I'll come back to your monetary question. In terms of the GDP that we see, it is very heavily massaged. It's guessed at. It's probably the worst quality statistic that's put out by the government, but it is also the most widely followed in terms of the broad economy. In terms of the advance estimate that we got a week ago, there's a plus minus 3 percentage point margin of error around that, and there's so much guessing that went in. The fact that the annualized contraction rate came out at a negative 0.1%, which is about as small a contraction as you could possibly get there. That could very easily been brought in plus or minus small amounts. I have to believe that the small contraction was deliberate, and my rationale behind that is that as we're coming into the political negotiations ahead, you have one camp that is looking to sharply cut government spending, and another that doesn't think we need any spending cuts. If you cut government spending, it will negatively impact the economy. So the argument, as I see forthcoming from those looking to continue spending as wildly as they want to, is that any fiscal reform at this point will be damaging to the economy, and they should put it off more into the future. I don't think that's going to work, because I don't think the global markets are going to give the United States any more time here. People have been sitting in abeyance since the crisis in 2008, but that's not working. all the changes then have not done anything to stimulate the economy or even to bring the banking system under control. In terms of the monetary end of things, you also have to consider, and particularly the world's reserve currency here, that our money supply, although it's viewed domestically, formally with the bank accounts that have been seen historically, you also have an overhang in the global markets. Excuse me, of something approaching what the M3 level is. I estimate now at about $14 trillion, and where the funds that the Fed has pumped into the system have ended back up as bank reserves and have not generally gone into the money supply. Indeed, that's why you're not seeing much inflation here. There are two things that are happening. One, the Fed is now moving to direct monetization of the Treasury debt, which actually does put cash into the bank accounts and money supply. We saw a little bit of inflation coming through quantitative easing too. The big thing, though, is when you start to see foreign dumping of the U.S. dollar. As long as the people outside the United States are willing to hold dollars as they are, it doesn't have any effect on our domestic money supply. Things are stable. But if you see massive dumping of the dollar, you're going to see the Fed jumping through hoops to keep the money supply under control, which it's not going to do if it means letting the stock market crash or the banking system fail. And there are going to be a lot of pressures there. So that what I'm looking for as a trigger to the inflation here will be a massive decline in the dollar, heavy dumping of dollar-denominated assets such as treasuries, and a Fed reaction from that to try and keep the system stable.
Could you explain the subtle difference, the important difference between GNP and GDP? For example, if Shell sell oil from the United States in the international markets, is that part of GDP but not part of GNP?
GNP used to be the number that was published, and the difference between GNP and GDP is what they call the trade balance and factor income. Factor income is the flow of interest and dividend payments. So when you have a net debtor nation that's paying out a lot more in the way of interest or in certain circumstances dividends than it's receiving, that actually subtracts from the GNP. So if they can look at the GNP without the negative there, it makes the large net debtor nations' GDP balances look stronger in terms of growth, where they're otherwise weakened but by the draining of interest and dividends from investors abroad. So that's
sorry, I'll get out. I don't want to be too greedy.
That's why it was changed. The usage was changed from the GNP to the GDP. The GNP is still reported, but the GDP was made the headline number.
All right. Thanks, John, for your question. Just like to keep things moving along. We have a question from Wayne, who's one of our attendees on the call today, one of our Paid Up Alliance subscribers. Says, if I'm not going to be utilizing GDP as determining the health of the economy, but what other factors will you be paying attention to?
Well, that's a very good question. The problem with the understatement of inflation affects the series that all get reported with inflation components in them, such as retail sales. Retail sales traditionally is a very solid indicator of economic activity. And if you look at it deflated by the Consumer Price Index, which is the way the St. Louis Fed reports it, it actually has just recently gotten back to the same level that you had before the 2007 recession. Unlike the GDP, it has not surged ahead well above where it was before the recession. The CPI in this case is overstated minimally by 3%. If you back that out, what you'll see is the retail sales, although it did come up higher, also has started to turn down anew. You'll see the same thing with industrial production. Industrial production actually has some components where to get to the production estimate, they use deflators that are troubled by the same hedonic adjustments that the GDP has. What you'll see is a similar pattern there where you had some pickup after the trough in 2009, and then it has started to turn down. If you look at those factors corrected for the understatement of inflation, and I do have those available on my site, you'll see that the economy has turned down as of second, third quarter. I think when all the GDP revisions get in July, that you'll see that was the beginning of the second dip, the double dip recession. You look at something such as housing starts. That has no measure of inflation in it. That pretty much has just been stagnant, bottom bouncing since hitting a trough in I think it was 2009. It has started to turn a little higher in the last couple of months. It's still down nearly 70% from its levels of 2006. You have had some pickups in apartment starts there that's helped to boost it. But the big problem here, and what I'd look at in terms of when is the economy turning around, one other key factor, employment. You look at the payroll employment. I have all sorts of problems with the series as to how it's reported. It's the current levels are overstated. But if you look at the general pattern, what you'll see is that employment has not recovered. It's a coincident indicator, not a lagging indicator some people like to put forth. You have no recovery there. That employment has moved higher, but you're not much above where you were back in the period before the 2001 recession. You're still well below where you were coming into the 2007 recession. We've had no recovery in employment. Until you see an employment recovery there, you certainly don't have it in the GDP. Simplest thing to look at, though, is the consumer. Consumer drives economic activity in the United States. And if the consumer does not have solid growth in his income, where his income is growing faster than inflation, you cannot have sustainable growth in inflation-adjusted consumption, which is 70% of the GDP. You have numbers published by the Bureau of Labor Statistics, for example, in terms of real average weekly earnings. They're down from where they were in 1972. It's down 10% or so. And they've been stagnant recently. They're beginning to turn down again. We did have a little uptick in the last month or two because of lower gasoline prices. There's a monthly survey that's put out by Centier Research, which is the median household income adjusted for inflation on a monthly basis. These are gentlemen prepared by gentlemen who came out of the Census Bureau. They're senior people there. Census Bureau publishes the annual numbers. They're doing it on a monthly basis. And what they're showing is that median household income, and you can put this in, if you look at it on an annual basis, which the Census Bureau does, in 2010 you were seeing median household income at the same levels that you had back in 1967. This is not a healthy circumstance for the consumer. And what Centier is showing is that the numbers started to turn down with the recession, but after the recession ended, the numbers just continued to plummet. Now they're bottom bouncing, but there's been no recovery there. Where this is significant for the economy is that, and these are numbers I would look at for signs that something's happening with the consumer that you need in order to get growth in the economy. If you go back to when Mr. Greenspan was Fed chairman, he was aware of this problem. This has been ongoing for a long time. He knew that there was no way there could be strong future economic growth, at least in the near term, that would be fueled by strong income growth. That just was not happening. So he encouraged consumer debt expansion, with credit cards, with home equity loans, and this was pursued throughout the economy, and debt was built upon debt, and we had a crisis in 2007, 2008, with a pretty broad collapse in the credit system. As a result, I mean, the problems that the consumer had with his income now, where back then he was buying the differential from the future by borrowing the money, making up the shortfall in his living standards by borrowing the extra cash. The average consumer doesn't have the ability to borrow like he did before. He cannot make up the differential, and that is what's killing consumption. It's why you've not had a recovery, and why there's none pending. The consumer's liquidity conditions are, if anything, getting worse. And so I'd look at I'd look at that center year research number. That's one that you get on a regular basis. You can also look at the Bureau of Labor Statistics monthly estimates of average weekly earnings. That's deflated though by the CPI. In reality, it's not stagnant. It's actually falling if you use a more realistic number. But those are things that will give you a general indication of where things are.
All right. Well, thanks, Wayne, for asking that question. And if any other Alliance members who are on the call would like to ask a question, you can just hit *3 and we'll screen your call. Moving along to another Brain Trust member, I know James Davidson had a couple of very important questions that kind of would reveal some of the things going on. James?
Yes, thank you, John. Andrew, I'm delighted to have a chance to talk to John. I have several questions, having been a big fan of your work for years. The first of these is why the Republican majority on the House Committee on Education and the Workplace has apparently done nothing to keep the Bureau of Labor Statistics honest.
Well, that's I can't answer that question specifically. I don't know the current politics close enough, but generally, what you'll find is that the manipulation of the data has been from both sides of the aisle, and in fact, the biggest push on this was from the Republicans back in 1990s in terms of the CPI. The Democrats signed on to it, and what you have now with the current budget negotiations, if you look back to the end of 2012 in the fiscal cliff, there was talk that they had reached agreement on reducing Social Security. The deal there was that they were going to introduce the chain-weighted CPI, which is fully substitution-based, as the method for adjusting cost of living for Social Security recipients. That's an outright fraud. It's not the way people view inflation. They're again looking for a measure of inflation that reflects maintaining a constant standard of living. People on Social Security say they can't make ends meet based on those changes are absolutely right. This is the second phase of it, though. Back in the 1990s, they successfully implemented changes which reduced the CPI, at least in terms of the way people thought the CPI was being calculated. Had that not been done, Social Security payments today would be double what they are, and that was pushed by the Republicans and signed on to by the Democrats. Newt Gingrich was the Speaker of the House at the time, and there's an awful lot of that that's been written and surfaced. And there was some objection raised from the public this last time around, but they're still trying to push that. Generally, the numbers that come out of the Bureau of Labor Statistics and also the Bureau of Economic Analysis and Census Bureau, they're worked on by people who have nothing to do with manipulating them. They take the numbers as they are. You have people at different levels who make decisions in terms of methodology, but the decisions that have been made usually have been done from the standpoint of making the inflation rate look better, the economy stronger, and if you're a politician, I don't care if you're Republican or Democrat, you tend to prefer to have numbers like that than something that makes you look like you're not doing your job. Again, this has happened on both sides.
So you see very little interest on the part of the Republicans to get honest reporting.
Well, look, my contention right now is that the federal government is technically insolvent, and that there's no political will to make the changes that have to be made in order to bring things into balance and to prevent an absolute financial catastrophe in the next couple of years. There are people who recognize that. But if you're a politician, you don't raise the issue unless you have a solution. If you're trying to balance the budget deficit, and also perhaps trying to buy some time and hope some miracle comes along to help you here, one thing you want are strong economic numbers, because the budget projections out for the next 10 years depend on the underlying economic assumptions. If you look at the underlying economic assumptions of 3% growth going forward, that gives you a certain picture on the deficit that's a lot better than if you look at something that's probably more realistic in terms of a decade ahead of stagnant at best and negative economic activity. You have to do a lot more in terms of trying to balance things out, so that it's.
Well, taking that point, I was wondering what level of economic growth would be required in your calculation to offset the continuation of the average annual gap deficit of $5.2 trillion, which we've enjoyed over the last 5 years. So
I haven't worked out that number, but I can tell you that it's beyond any conceivable level of attainability.
Has any economy ever grown fast enough to grow out of this?
No.
You're
looking at something right now where the deficit is running at 40% of GDP. That's the real annual deficit.
So in other words, you'd have to tax away every penny earned by everybody, and you still wouldn't balance the budget.
You can, to bring this, if you wanted to bring the current actual deficit into balance, you could tax 100% of wages and salaries, and you'd, take 100% of wages and salaries, you'd still be in deficit. You cannot raise taxes enough, and I'll contend that the economy already is at that tipping point, if not beyond, where the more taxes you raise now, the less revenues you actually generate because of the impact it has on the economy. The economy weakens further because of the higher taxes, and the revenues fall. The government's had many years to work out that fine point. They keep pushing it as far as they can, and then they have to pull back a little bit. So that even if you could, and you could just keep things as they were, it wouldn't. You could not bring 1 year into balance. On the spending side, if you cut spending in every, if you took all government spending except for the social programs and reduced it to zero, completely eliminated the military budget, for example, you'd still be in deficit. There's no way this thing can be balanced without there being a reorganization of the social programs so they are in balance. And I think we've seen demonstrated fairly consistently in the last couple of years that the people controlling Washington, although there are people there who would like to do something, but those in control, what you have, the people that you've got controlling the economy for the next 2 years are not going to do that. And I don't think they've got more than 2 years to get this worked out. I don't think they've got the next 2 months to work it out. I mean, they're trying to buy a couple of months here. I don't think the markets are going to give them much time. But you're not going to get into another election without this blowing apart. So whoever's going to work it out, it's got to be done within the existing political structure.
Let me ask you another question, which comes back to what you mentioned about Centier's numbers showing that real median income had fallen to, 1967 levels?
Well, Centier doesn't show that per se. They only go back to 2000. But they're using the census numbers that are published with the poverty report. And if you use the CPIU, the standard CPIU, same thing that the Centier guys do, you'll see that the income levels in 2010 were the same as in the late 60s, early 70s.
Well, suppose we use the inflation calculation as it was done in 1980. What would it be then?
You don't get any growth. It's sort of a smooth downtrend, which suggests that much of the strength that's seen there has been tied to inflation. The government's inflation calculations and changes in the inflation calculations. When they lower the inflation rate with a one-time change, you get a one-time boost in economic activity or income growth. One thing to consider here, and again, you have to look at the broad inflation number when you're looking at the consumer numbers. When you look at the GDP and just the hedonic adjustments, there are people that'll look at Japan and say, "Oh, the Japanese economy's been mired in stagnation for an extended period of time." The Japanese didn't buy into the hedonic adjustments initially. Neither did the Germans. And if you look at the early numbers in comparison, the U.S. economy took off relative to them because of the hedonic adjustments. It wasn't that the economy was turning around; they changed the way the GDP was reported. And it had the GDP calculations been kept in the United States as they were, our economy would have been as weak as what was seen in Japan. The others are now use the hedonic adjustments. Again, it's still controversial, but the U.S. pushes the international standards that are used, and so things are catching up a little bit. But
so pink slime is equivalent to a filet mignon.
Yeah, right.
All right.
But you don't have a personal calculation of what the level of the median economic real income would be as in terms of a year equivalent if we were still calculating inflation as we did before they started all this mischief.
It'd be it'd certainly be well below where you were at the in the 60s.
So in the 50s?
And there's some reason for that. You see this with the wage numbers out of the Bureau of Labor Statistics. It has to do with our trade policies and the way trade has flowed, with the effect of our production base being to a certain extent lost to offshore competition. And the higher paying production jobs have disappeared. You look at where incomes were back in 1970 for the individuals and where they are today, the shift there has had tremendous impact on our society. I mean, back in the 70s, it was much more common that with a household, you'd have one person working. Usually the husband, the wife would stay home with the kids. Today, to a large extent, because of the income problems, you have two or more people more commonly working in a household. And even so, the household is still not staying ahead of inflation. you're not going to get the consumer end turned around until such time as we can somehow begin rebuilding a production base in the United States. Production creates wealth. The policies that have led to this extraordinarily large trade deficit have had the effect of transferring wealth from the United States to our trade partners who are running big surpluses against our deficit.
All right, thanks, James. Just wanted to jump in here. I've got a quick asset allocation question from Alliance member Barbara. Sounds like she owns some gold stocks, but wants to know if hard cash would be a better investment option.
I'm sorry, what, hard cash?
Right. As opposed to gold stocks.
Well, to start with, if you're talking U.S. dollars, I'd stay away from the dollar. I would. I have no problem with gold stocks, but you have to keep in mind that if things get as hairy as I think they're going to get, you would do well to also have some physical gold, because the physical gold is liquid. And let me back off a bit. If you look at the extraordinary hyperinflation that took place in Zimbabwe, worst ever anyone's ever seen. If you took what were the initial $2 bills at the base, the base paper money in circulation, and if you could have printed $2 bills in the last iteration of what they had, if you took a stack of the inflated versus the old, it would reach literally from the U.S. to the Andromeda galaxy. Light years high, not enough trees on Earth to print it. Yet this took place over a period of a couple of years. The economy continued to function, people worked. The reason that happened was that they had a backup in a black market U.S. dollar. So you got paid, immediately exchanged whatever you were paid in the black market for what dollars you could get, and then with the dollars it acted as that hard asset. Same thing as it was like the gold of the time. Then you're able to pay your rent, buy your groceries. The United States is not ready for a hyperinflation. We have no backup system, and as such, it's going to be very difficult, unusually difficult time. If I'm right on how this breaks, having the physical gold gives you some backup. You need some physical silver as well as for small change. I don't see this as being a happy circumstance in terms of how people live day to day early on, because it's the type of thing that's likely going to disrupt the normal flow of commerce, where you could see grocery stores empty because the trucks aren't running. So that I'd also look at building up something of a stock of goods, the type of things that you'd need to live on for 6 months: canned food, diapers, whatever you need. You can also use that for barter, which I think will evolve in that type of a circumstance until you eventually end up with a new currency. But consider too that right now you cannot get a safe return in the United States that beats the rate of inflation. You're still looking at negative real interest rates here, let's say against a treasury bill, so that you actually make more money going out and buying goods and letting them inflate than by putting the funds in a treasury bill. It's a very unusual circumstance. You don't normally see things like that. In fact, nobody's ever seen the combination of factors that we're seeing here, and it's this whole confluence that's going to lead to some very extraordinary times ahead. But the gold stocks, the reason I wouldn't rely on them entirely is that you could have disruptions in in the financial system, you might not be able to trade or sell your stocks. Long term, they'll be fine in terms of the value. So I'd look at them as a longer term hedge. It's a good hedge, but something that you look to hold for after the crisis has passed, and use the physical gold and silver for at least as a component of what's needed to keep to preserve the purchasing power of the assets and the liquidity of the assets during the crisis.
All right. Well, thank you, and thanks to Barbara for asking that question. Up next, I'd like to turn things over to Ashish Advani, one of our Brain Trust members and currency investor. Ashish?
Hi, John. Thank you very much for all the great information. I have one question, sort of 1A and B. Question is, when do you believe the U.S. dollar will lose its reserve status? And 1B would be, who do you think? I mean, although all currencies are fiat at this point, however, the immediate result could be U.S. dollar losing reserve status. When do you think that will happen, and who would replace it?
Well, that's a good question. I think you'll find that that will happen within the next year, probably coincident with a very heavy selling of the U.S. dollar that I think is ahead. If you look at the fundamental factors that will affect the dollar versus other currencies, you look at factors ranging from relative economic strength, interest rates, political stability, fiscal conditions, trade balance, and generally the U.S. is on the negative side of all of those against most of the other major currencies. In fact, I'll contend that the fiscal circumstance is the thing that's likely going to blow this up. If you go back to the early part of 2011 and the so-called Arab Spring, there are things happening there that would, in most normal times, have led to a flight to the dollar, a flight to safety in the dollar. Instead, what you saw was a flight to safety in the Swiss franc and gold. And I think at that point in time, the confidence in the dollar had started to wane, or it was losing its safe haven status. If you go to the the deficit negotiations, July, August of 2011, the deal that came out there, which again they're still seeing extended in the post-election environment, you saw massive selling against the dollar, particularly versus the Swiss franc. There's all sorts of manipulation, intervention. The Swiss tied the franc to the to the euro, which had the effect of also limiting its gain against the dollar. But the markets had responded very negatively there, and I think at that point the confidence in the dollar had been very, very much destroyed, and that's still the circumstance. One thing that happened at the time, the markets redirected against the euro, and that took some pressure off the dollar. And I don't know that the euro is going to survive as it is. There's certainly some problems with some of the countries in the euro, but all in all, the euro, I'll contend, if you could, and it's just a hypothetical circumstance here, if you could break the euro into its original component currencies, let the currencies float to a fair market value, and then recombine them, you'd be seeing it up around 180 instead of down in the 130-35 range. Whatever happens there, the German component, the mark, if they break it into different currencies or more limited euro, wherever the mark is, that'll be a very strong currency and one that would be a good hedge against the dollar. But even so, with the problems of the smaller countries there, I still view the euro as a better bet than the dollar. I see other currencies as a better bet than the euro, such as the Swiss franc. I think that they'll break free of their tie there in the near future as the selling pressure on the dollar, in particular, builds up. I also like the Canadian dollar and the Australian dollar, but it'll be a problem with the U.S. dollar, with U.S. inflation. So that there'll be a flight to safety outside of the dollar. The fact the dollar, the flows, let's say, go into the Australian dollar, it creates its own liquidity. As the dollar drops, the Australian dollar is absorbing and able to absorb more U.S. dollars, and the same with other currencies. So that at this point, my betting would be as the hyperinflation kicks in, you will have lost the reserve status by the time that happens. I don't know if the movement's going to come out of OPEC or otherwise, probably OPEC, because there's some unusual things that are going on there. As that happens, again, whether it's a coincidence with a massive sell-off or whether it triggers a massive sell-off. My betting would be it'll follow a massive sell-off, and then that in turn will intensify the dollar selling and intensify the inflation problems in the United States. Where the other currencies will be doing much better relative to the U.S., they act as a hedge. But again, the U.S. right now, the dollar accounts for something like 80% of the volume of, half of on one side of the global currency transactions. And there's no way you can have this happen to the dollar with a global currency system staying the way it is. So I expect you'll see fairly rapidly a reorganization of the global currency system. My betting will be there will be some tie of gold to it in order to sell it to the public. But putting the U.S. on a gold standard would do nothing to resolve circumstances unless the deficit problems are resolved. The fiscal circumstance has to be in balance. Money supply would impose, a gold standard would impose control there, but unless the system's been restructured to live with that, you end up with a currency that continuously gets devalued against gold, and we're still in the same circumstance that we are. So out of this, however it comes, and it's anyone's guess as to how it all works out, I do think you're going to see a greater involvement of gold in the global currency system, and there will have to be some reorganization of the fiscal system, the relationship between the U.S. government and its people, in order for things to go forward. We just don't have the demographics for the general population to support the system the way that people in Washington would like to see it supported financially.
All right. Thanks, Ashish, for your question. Moving along, I know another Brain Trust member, David Nelson, had a question for you.
Hey, John. It's David Nelson. Thanks so much for being on the call today. It's very informative.
Oh, you're not by any chance a former currency trader?
No, I'm not. I'm definitely actually currency is definitely not my strong suit. But I'm glad you mentioned currency because I got a couple of questions and some. I have to take difference with some of the things that you're saying. While I agree politically with some of your observations. First, on the currency, you seem to be very focused on the dollar, but I look around the world, and certainly a lot of the export nations. It seems like a race to the bottom, and they're all trying to push their currency down. And you focus on the euro perhaps being a better hedge against the dollar. And I question that even as a currency, because you're talking about a currency that doesn't have a common government.
Right.
And I'd like you to expand on that a little bit.
Okay. Well, basic supply and demand, the more you create of something, usually the more it goes down in price, unless you can get an increasing and offsetting increasing demand. In this case, the Fed will be creating tremendous amount of dollars. Already has done that, although it hasn't necessarily work into the system. The U.S. has done to its fiscal balance more damage than anyone in the world in terms of the major nations, followed not too far behind by Japan and the UK. So we're the worst. Japan is in many ways healthier. It's has a populace that saves, and you do have generally a much better trade picture there than the United States. The big issue in the U.S. are the double deficits. The trade deficit, we've got the worst in the world, and in terms of the major countries, and in terms of the actual fiscal deficit, we have the worst in the world, and also in terms of the aggregate obligations. I mean, we're at somewhere it's close to 6 times the GDP level, up around $85 trillion in terms of those obligations and net present value. So that where you have the world's still biggest economy in that type of a circumstance, world's dominant currency in that type of a circumstance, you're going to have really a shift here that is unprecedented in terms of global holdings of the currencies. But as such, it becomes extraordinarily disruptive, and as people flee from the dollar, I can't think of anyone who really outside the U.S. wants to see their assets in U.S. dollars. To the extent they're holding treasuries, that's very commonly due to political circumstance. You look at China recently made noises about how the United States should probably slow down in its creation of money. Indeed, the monetization of the treasuries does create money, does get into the money supply. You're seeing comments that are being made that in the normal course of business would never be done publicly. This is all stuff that's a bit behind the curtains. The fact that it's being discussed publicly is also, I think, an effort there to make the public a little aware that there's a major problem coming. But very quickly, just one. Let me finish one sentence here. Very simply, in terms of the major metrics, the U.S. dollar is the most negatively positioned current major currency that I can think of, and we're actively pushing it to the brink of effectively shoving it into the noses of the foreign investors, where we're going to get a very negative response.
All right. Well, thanks, guys.
Can I have just one follow-up on that, Andrew,
sure.
if I could? Because my biggest question here is we're talking about a potential. You're referring to a potential economic collapse here in the United States, and
yes.
Hedging in gold, and even so far as to go into even something as safe as canned goods. You're really calling for a stock market crash, and it sounds very shortly. Yet, I'm looking at a screen here with, hundreds of stocks that are pushing to all-time highs, not 52-week highs, all-time highs.
Yeah.
So this is going to happen very, very rapidly, in your opinion. What's going to be the trigger?
Well, I think the trigger is going to be the dollar. But keep in mind here, this is not new. We came to the brink of Armageddon back in 2008. We're not kidding about the banking system collapsing. At that time, the federal government, did everything within their power to prevent the system from collapsing. They created whatever money they had to. They lent. They spent. They guaranteed whatever they had to do to keep the system afloat. They didn't do anything to resolve the issues. What they did was they pushed things down the road. The economy is never recovered, and it's getting worse again. The banking system, maybe it's a little more stable, but it's not functioning normally. The banking system is still in serious trouble. If it were functioning normally, you'd be seeing adequate lending to start to prop the economy. That simply is not happening. The economy is turning down anew. That makes the situation even worse for the banks. Keep in mind, as the economy turns down, it means that the deficit's going to be worse than is projected, irrespective of what they do with it. It means the Treasury funding needs are going to be higher than expected, and it means the banks are going to be pushing those the limits of those stress tests. What we're coming up on here, in many ways, is not going to be that different from what happened in 2008. It's just the second stage of it. But it's one that they don't have a way of getting out of. They bought time. They pushed it into the future, but it's the alternative might have. I think I would have done the same thing they did at that time. Nobody wants to see a system crash. We shouldn't have gotten there. There are things we should have done decades before, but we're not done. We're the things that should not have been done decades before. But what we're seeing here is still the play out of the near systemic collapse in 2008, and I mean you lived through that as I did. That actually happened. We're not dealing with any kind of a normal circumstance here. We're living with the second shock of what happened back then.
All right. Well,
thank you, John.
Thanks,
You're
Dave.
most welcome.
Appreciate that. Got another asset allocation question. This one comes from Steve, one of our Alliance subscribers. Asks, if you have a large amount of money in a deferred compensation plan, that's say 10 years out, would you rather take it out now and pay the taxes on it, or wait?
Well, it depends how it's deferred compensation. I'm not an investment advisor. I'm a simple economist. But I can tell you that depending upon with whom this is, you have you're not likely going to have the economy that you see today, nor a lot of the same companies that you see today. I'd be inclined to take control of my assets now, if to the extent you can.
All right, then. Among our Brain Trust members on the call, I believe Barry also had another question for you. Barry? Still on the call? Okay, not seeing that. Among our other Alliance members on the call, I have a question from Steve, who is asking about real estate. Okay. Given the recent improvement in housing starts and purchases in residential and commercial, it looks like some people are starting to come back to the market. Does it look like real estate would be a good thing as a hyperinflationary asset, or could it be a bad thing because of the overstatement in GDP numbers?
Well, I would contend that we're not really seeing a sustainable comeback in the real estate market at this point for two reasons. One, a consumer lacks adequate liquidity to fund significant gains there, and two, there's still problems with bank lending. And your consumer confidence is falling off anew. I don't think the relatively happier numbers are going to be sustained as the economy turns down again. But even as it is, I mean, it's all relative. It certainly is better than it was, but you're still down 60-70% from where you were in 2006. In terms of real estate, as a general asset class, I'd certainly look at it as an inflation hedge, a hyperinflation hedge, with the following caveats. Again, I would look at this as with the gold stocks as a longer-term hedge. You're getting through difficult times. You need to have enough liquidity to cover you through the difficult times. And real estate may have some liquidity problems for a while. I mean, there's been some issue with that. It's not portable, but it's a type of thing. The word "real" in it, that's there because it is a hard asset. It does retain its value over time, and from that standpoint, it's a great hedge. Going into the much more speculative area, I can't tell you how the hyperinflation will evolve once it breaks here. What it does to things politically, and it's a type of circumstance where you could have political upheaval. I'm not predicting that. I'm just saying that is a possibility. If you ended up with a reorganized system that didn't allow private ownership of real estate, that might not be a circumstance where you'd want to be holding real estate in advance. But I'd put the risk of that as relatively low. Generally, I'd look at real estate as a hedge here. Got to be viewed from the long-term standpoint. Maybe outside the United States.
All right, then. Believe we have Barry on the line again. Barry, you there?
Yes, I'm here. Can you hear me?
Okay, there you are. Yeah, coming through.
Oh, good. Hi, John. Thanks a lot for the talk. My name is Barry Elias. I had a broad economic policy perspective and a hypothesis, and I was wondering if I could hear your comments.
Sure.
So it's very interesting for the people on the call to hear you say that like roughly 70% of the economy is due to consumption, and I think that's the main reason for the problems that we're in. Back in 1960s or so, like consumption represented 45% of the economy or so.
Yep.
And investment has really shrunk a lot since then and being replaced by consumption. And when you have investment, the economic multiplier is increased because the growth is started from the beginning of the production process, you're not paying at the end of the production process as in consumption.
Right.
And and what's coincident with all this was back in the 1950s and 60s, the corporate income tax rate was a lot less than the personal income tax rate, giving more incentive to invest in business that would be sustainable. Now, especially since 1986, when Reagan had the tax deal, personal income tax rates became much lower than corporate income tax rates. That differential, I think, drew a lot of money out of business, out of investment. And the Federal Reserve even shows that monetary velocity since 1980 is like roughly in half. And I think that's the main reason for this stagnation of income growth. Like you say, real adjusted inflation growth with your statistics, not the government statistics, shows that we're basically at the same point as we were in 1960, and in my view, no surprise. So I would suggest this in terms of a long-term policy perspective to keep rates low, but always keep the corporate rate a good deal lower than the personal rate. Would you concur with something like that?
Well, it is what you want to have as an end result here. Looking at it from a slightly different angle than you have in an area that I've mentioned before, is that we need to move back towards a production-based economy as opposed to the service-based economy. I mean, that's over the same time frame that you've had a tremendous shift. And the reason that the production base was shifted offshore was due to a lot of competitive issues, including relative wages, government regulations, taxes on businesses. Generally, as far as I'm concerned, the lower you keep the taxes, the better. I mean, that generally is, in normal times, is a circumstance that will tend to stimulate economic activity. And yes, I would tend to keep the corporate rate lower than the individual rate. You might consider making dividends tax-free, in that they've already been taxed at the corporate level, but I'd have no problems to that approach. I think that generally would be a plus to the economy. And lower rates than we have now, but it's not a. I'm afraid that's not in the works, and we don't have. There's something that could be in place in normal times within the next several years. It will require change in government, but we don't have. I don't think we have that much time to.
Sure.
To get things shifted around, and even if it shifted around, if we had a 5% economic growth per year, which would be a booming economy, and the figure 3% average for the GDP, and we haven't. Throw back to an earlier comment. The margin of error on that growth is plus or minus 3 percentage points. But
right, big margin.
3% sort of average. If you had 5%, which would be sort of the upside limits of what you could see on a sustainable basis here, it doesn't get us out of the deficit circumstance. But generally, what you're talking, that's I generally don't have any problems with that.
Thanks a lot, John.
You're welcome. Thank you.
Yep.
All right. Thanks, Barry. Appreciate it.
Thanks, Andrew.
Got time for one more question, John. I believe we've got Sean Hyman who has a question for you. Sean?
Yeah, thank you. I was just curious as to when you thought the velocity of money would pick up, and what might bring that about, what might be a catalyst for that.
This is in terms of M1, M2?
Yes.
Okay. Well, my preference is to look at M3. The broader I find, the broader the measure of the economy, the more it tells you about what's going on.
Mm-hmm.
I still track M3, or at least estimate it. Most of the numbers are still published by the Fed. And what you'll see is that with M2, the last year or so, generally the money supply was falling off. The velocity was falling off. That's because M2 was growing faster than the economy was. But if you look at it from the standpoint of M3, velocity is actually rising. The reason that M2 was rising was that you had a lot of cash flowing out of institutional money funds and the large time deposits that were in the old M3 category into the M2 and M1 category. So it looked like M2 was growing, but it really was a shift of funds out of M3. Again, that's why I like to look at the larger measure. I have some problems with velocity in that it's a residual number, and although I estimate the M3 using the Fed's numbers, the money supply is not well measured. The GDP is it's a dog's breakfast in terms of what's put into it and how it's put together. So that in theory, those numbers all relate, but it is, and of course the price measure. A lot of argument as to what's being used in terms of the implicit price deflator. Again, there's probably an extra. You're getting an extra 2% percentage points growth out of the GDP because price deflator is understated by about 2 percentage points per year because of the hedonic adjustment. So the deflator, the velocity is something that can be jerked around depending upon the assumptions and the measures that are in place there. We do track it. I would tend to look at the M3 as a more reliable measure, but it's not a just off the top of my head. I wouldn't put too much credence in it as an indicator of what's happening. It's interesting, but it's unless the other numbers in the equations are close, it's a residual of bad statistics.
Awesome, thank you.
You're welcome.
All right, folks. We are getting on about 1:20, so I'd like to thank John Williams, our special guest, for staying on so long, as well as all of our Brain Trust members for joining today. As always, for our members, if you have anything worthy of discussion, feel free to send your thoughts around via email. And we'll be having our next call on Friday, March 1st, and I will have more details out to you on that as it approaches. So thanks for a great call. Bye.